Hello and welcome to Stockwatch, presented by me, Evan Lucas, for Go Market Securities. As always, please have a regular read through of the disclaimer on screen. Everything in this video is general in nature, none of which relied upon as any form of personal advice. Go Market Securities does not know your personal scenario, nor your personal financial goals, and therefore none of which relied upon as any form of advice at all. It is just general in nature only. Want to look into the banking space. I'm going to break the banks out because CBA is the one to watch here. They're the only ones that are going to report in the upcoming earnings season, and they remain the premier banker for a reason. But, and it is a big but, you can hear from Matt Common and co in that senior C-suite section that they are very, very worried about FY24. And I think that's what's going to be the story. They are likely to show you possibly a record result. There is every chance, considering at the start of the year, they showed you that for the first half of FY23, momentum still carried on. I mean, almost 1 in 2 people in this country bank with CBA. It's not just that the margins that CBA was starting to put in was better. The caveat is this: they are not having to compete as hard as they were before. That's a good thing. But the discount they're being offered to clients is lower. They are starting to see some form of churn. And not only that, their loan growth is starting to really seize up. Not surprising, considering that their standard variable rate currently sits at about 6.5%, which means under the APRA laws, you've got to add 3 to that. So 9.5%, loan growth was starting to come to a bit of a 4. The next part, and the big question, is bad and doubtful debts. At the start of the year, they showed that bad and doubtful debts were still well and truly below standard. In fact, not just well and truly below, at some levels that we haven't really ever seen. Now that is going to have changed. That needs to be pointed out very clearly. There is going to be an increase in that. They are also clearly having to work with some clients about how they're going to deal with this period. So cash earnings will probably be a record. Does that mean a dividend could be a record? Yes, but I actually think that in FY24, they are worried about this slowdown. They are worried about what it means for their loan book, and they are worried about what it does for the overall future of the long-term bank prospects. So the caveat here could be that the dividend is held and that they don't give the payout ratios they have in the past. They are going to talk about net interest margins being above 2 and that makes them healthy. That's a fair call. But at the same time, it possibly could alienate their clients. And that is why at the moment, banks are walking a tightrope, and CBA will be not really a canary in the coal mine, it's the gorilla in the coal mine. Because whatever CBA does, all others will follow. And that's why it's going to be the absolute standout in the upcoming earnings season.